The Money Show. Personal finance.
Well, Warren Ingram, personal finance this evening, and good timing here, Warren, on topic choices. The Rand stages a very brave comeback from catastrophic to awful. The Rand having a much better time of it in the last day or two as American inflation, at least in the short term, is showing signs of dissipating. How much attention are we needing to pay to the Rand-dollar exchange rate when it comes to moving our few little mini-pips offshore?
It's amazing that we pay an enormous amount of attention to it. It's probably the question I'm answering the most every single day, whether it be at work, socially, just kind of driving in the traffic, people winding down their windows and saying, what's happening with the Rand and when should we send our money out? And,
I think you should wear a fake moustache and a wig because that's harassment. It really is.
It is, and it's clearly top of mind for everybody, and it's something that occupies a huge amount of our energy as investors, as South Africans. I think the professional fund managers, it's also something they look at. And I guess the short answer to your question is we should pay a lot less attention to the Rand. And I think it's always important to understand, when you're looking at investing overseas, and that's a whole topic on its own. But when you are going to invest overseas, and you want to convert your rands to dollars, it makes sense that you're watching the Rand as part of your calculation. But what most people forget, and what they don't really focus on, is once the rands have been converted to dollars, it's much more important what you're going to do with the dollars on the other side. And so for most of us, if we're investing money overseas, unless we're trading or we're a foreign exchange business, or we're an importer or exporter, we're sending money overseas for multiple years or multiple decades. In other words, we're making very long-term decisions. And if you're investing very long-term, the bulk of what you invest overseas should be in stock markets. It shouldn't be sitting in money markets. And if you're going to invest in a stock market, what you need to understand is how expensive or how cheap is that stock market that you're going to buy. And that's a super critical decision. It's probably, if we have to give it a rating, the Rand dollar being 1 out of 10 important, then 9 out of 10 is how cheap or expensive are the assets that we're going to actually buy with the dollars once we've got the dollars. And I think most people, they forget that part of the equation. So what they look at is they say, goodness, a week ago, the Rand was at, 1901 to the dollar, and I can't possibly send my money out. So I'm just going to wait for things to get better. Now, it's important to understand why the Rand will get better. And almost always the Rand gets better because appetite for risk goes up around the world. In other words, investors start to feel a bit more confident. They're looking around and they're saying, gee, there are opportunities now. We're not so fearful as we used to be. And so we're looking for places where we can get return on our stock market investments or our bond investments. And inevitably, that tends to favor all emerging markets. And then the Rand, because it's one of the most liquid emerging market currencies around, it tends to benefit irrespective of what's going on in South Africa. And I think that's an important thing to understand. So if things are going to get better when you're now waiting for the Rand to go from 19 to 17, it's also going better in stock markets. And so what happens is you feel now really clever because you've waited and the Rand's gone from 19 all the way down to 17. You feel like a hero because you've timed that perfectly. You convert your Rands into dollars and then you send it overseas, and then you decide to buy shares. Unfortunately, those shares have risen by pretty much almost the same as how much your Rand has now strengthened. So what you've lost on one side, you've gained on the other, or what you've gained on the one side, you've lost on the other. So it's absolutely a mug's game to try and figure out how we actually convert and when we should convert. What we really should focus on is on the other side. So if the Rand was sitting at 19 to the dollar and the global markets were incredibly expensive, they'd just been rising and rising and rising, then it makes all the sense in the world to say, okay, now I'm going to wait because the assets I want to buy on the other side are expensive. And the Rand is really horrible at the moment. I'm just going to be patient and wait for either the international markets to come back to me or for the Rand to strengthen somewhat. And I think to give you context, when you look at the rand over the last 22 years, and that's been a fairly horrible 22-year period. It's not as if it's been a great time. The rand tends to fall by about 6% a year over an average 5-year period. And so it's not as if, when you send your money out that you're guaranteed to make sort of 15% a year just on the rand depreciating. It doesn't work like that. If that was so easy and so mindless, we would all be sending money out and borrowing in our bonds and just sending it out all the time. It doesn't do that. Today, and actually the last week, is a very good example of how the rand can strengthen, even though we're at stage 6 load shedding again, and our economy is terrible, and all the other things that are going on. It's global moves that happen very quickly.
No, absolutely, Warren. I mean, you make a compelling argument, and it's a good argument, and one that I buy completely, that what you think you're winning on the swings, you're actually losing on the roundabouts. So really, what you should be doing is, in the same way as you should be putting money from on a direct debit into your investments locally, if you want to put money offshore, you should be doing the same sort of thing, regardless of what is happening in the macros, provided you're not buying into markets that are overheated and stupidly priced, as was the case in the sort of 12 months, I suppose the 2021 year, the year after COVID, where interest rates were so ridiculously low and prices were just going through the roof, and it was going to be impossible to sustain those sorts of prices. If you've got sensibly priced markets, you really should be investing and investing constantly.
Exactly right, Bruce. And I think if you're sitting in a position where you have to do lump sums overseas because you're applying for tax clearances, and that's not so easy to do debit orders, then take a lump sum, whatever the amount is, and divide it into 3, and just say, I'm going to send the money out every 3 months in 3 batches. So I'm going to do a third now. Then I'm going to wait 3 months. I'm going to do another third. I'm going to wait another 3 months and do the last third. And just make peace with the fact that in that period of time, you might be getting a fantastic exchange rate. You might be getting a horrible exchange rate. But over the average is really what's important to you. So for people that are converting rands to dollars and they're doing lump sums, then phase it. There's nothing wrong with doing that. Just the reason why you don't want to do that every single month is because you want to limit the transaction costs of converting your rands into dollars. The foreign exchange dealers, they're going to make their pound of flesh on you, and so the fewer transactions you can do and the larger amounts you can do, the more it's going to favor you. But the debit order route that you're mentioning, the one way to do that is buy a rand denominated offshore investment. So in the unit trust world, they've got a horrible name. They're called feeder funds because the rand denominated fund feeds into a global fund. So you can do that. You can buy a rand denominated exchange traded fund, and you can do a debit order into that. Absolutely, without having to think about it. You just sign the debit order, keep going. And then once a year, or once every 2 or 3 years, depending on how much you're sending, you can then convert that into a dollar investment and just send the money out. So you can do the debit order, and you can do it with the rand hedge one. But I certainly wouldn't want to do that every month by converting rands into dollars. I think you just get killed on the foreign exchange costs.
Absolutely, the cost of moving cash overseas is absolutely enormous, and that is, if there's one price that you're going to pay attention to when you do this, it is not only the rate of exchange that you get, and you've got to get the very best rate of exchange at the moment that you can, but also the price you're going to pay to move that money. Because if it's a percentage point or 2 percentage points or 3 percentage points, whatever it might be, that makes all the difference in the world, especially if you're doing it fairly often.
Exactly right. And I think it's, we kind of get, we focus on the one thing and miss the other, so we get really excited now because the rand's at 17.91 or whatever. And we think, okay, great, I'm going to buy. But unfortunately, we don't do the homework on how much we're going to get charged. And so we end up, converting our rands actually when it arrives on the other side, we've ended up doing it at 18.20 because we got drilled on costs. And I think that's the thing to focus on. You're right. You can't just focus on the exchange rate. It must be the costs as well.
Not everybody, and in fact, very few people, Warren, in the real world have got money to move offshore. They haven't got the tens or the hundreds of thousands required to make it financially worthwhile. The best they can do is buy sort of dollar-denominated assets in South Africa. So they can convert, they can buy rand hedge shares, or they can buy dollar-denominated assets in South Africa without actually moving the cash offshore. For most people, that is what is most applicable. And again, I suppose the same rules apply.
Yeah, I think if you're doing, there I would say focus on doing monthly business, focus on doing debit orders, because you're kind of instilling a discipline in yourself where you're not focusing on what are the markets doing, trying to get into this, the idea of market timing, which it's a very attractive idea and very easy to do with the benefit of perfect hindsight, but impossible to do when you're trying to make sensible decisions, looking forward. So doing a monthly debit order into a rand-denominated offshore fund instills discipline where you're just doing it. You don't have to think about it. And if you look back over a 3 or 5 year period, you'll find that you'll end up, accumulating most of the time decent assets at a decent price, and because you're not trying to time the markets, you're not making really bad decisions, which unfortunately is what happens to us as human beings. The most intelligent people get swayed by emotions of markets, and then they end up with hindsight making really silly decisions, and that's just the impact of emotions on our decision making, and the fact that there is nobody in the world anywhere that can forecast currencies and stock markets and do that consistently. It's much more reliable to kind of call heads or tails and just go with whatever your heads or tails does. And obviously we don't want to rely on luck. So rather do the debit order route, and just close your eyes and do it, and have a discipline. One thing we know about investing, it doesn't matter whether it's in South Africa or overseas, is it's certainly about long-term capital growth and letting the little bits of market return compound on each other, and get the money to make money babies, and the same applies in this. Just be consistent and stick to it. And the nice thing about unit trusts or exchange traded funds, is you can kind of do 500 Rand a month debit order. You don't need to be doing tens of thousands or millions of rands, or hundreds of millions of rands. You can do small amounts and just be consistent. And it's pretty much accessible to most South Africans who don't have catastrophic debt.
Warren Ingram, a certified financial planner. Warren Ingram co-founded Galileo Capital with us this evening. Warren, a question for you from Caroline Braz. Now, Caroline has sent a really interesting and very different question to what we usually deal with, and I'm curious as to what you think on this one. I'll give you a moment to pause and consider. Please would you ask Warren what I can do with my pension fund money? I've been on a disability pension since 1999 while still contributing to my pension fund. I receive a monthly pension of around 19,000 Rand until July 2024 when I turn 65. My pension fund will then pay out a final amount to me. This is when I don't know what is best to do. I've no debt, but I'm still very worried, and any advice would be very much appreciated. I've heard you once say that an RA together with a life annuity could be a possibility. Do you still think this would be a good idea, given the way the markets are now? That is kind regards from Caroline Braz. That answer for you, Caroline, from certified financial planner Warren Ingram, co-founder Galileo Capital, in a moment.
The Money Show. Personal finance.
Warren Ingram, what about this conundrum that Caroline faces? Approaching retirement, has been on a disability pension since 1999, now at age 65 in July 2024, so a full year from now. Good thinking, Caroline, for planning this far ahead. Wants to know what the pension fund, which will pay out a final amount to her, doesn't know what to do with it. Some thoughts.
So I think it just for people that are listening, they might find that kind of a bit strange that you're getting two forms of a pension. You're getting a pension, and then you reach retirement age when you're not actually working anymore, and then you get another pension. So just to explain that very quickly, when you are disabled, your disability basically pays you an income to replace the salary that you would have earned, and it doesn't do that for life. It does it till the age that you would have normally retired. So that's why in Caroline's situation, it's paying out until she turns 65, and then the disability pension stops, and then she gets a normal retirement fund as anyone else who was working and contributing to a retirement fund would have got. So although Caroline's disabled, that actually doesn't change the mechanics of what happens next at age 65. So
effectively, Caroline has had an income since 1999. She would have, I'm sure, preferred a different kind of income and definitely a different kind of life. But she had the good sense to have the cover that provided her with the disability income up until the age of 65, and she has been contributing to another pension fund in the meantime, which is, again, incredibly sensible.
Yeah, absolutely. And so, now being in a position to kind of plan ahead, and so I would say, Caroline, don't do something different to what anyone else would do in the position you're going into now as a retired person. In that you kind of, firstly, my biggest piece of advice will be, make sure you've got proper asset class diversification. So if you're going to kind of convert your retirement fund, it's either going to go into a life annuity or a living annuity. If it's a living annuity, that's just a kind of, just for most people out there, a normal investment portfolio. It can hold cash, bonds, property, and shares. And I think, most of the time we should be buying things like balanced unit trusts or something that has a very high allocation to shares and then a smaller allocation to cash, bonds, and property. And I think and most of the time now, balanced funds have about 45% of their investments overseas. So you're getting really good diversification in a very simple vehicle, like a balanced fund, and your living annuity can own that. And then the trick is to make sure you don't draw too much from that living annuity on the day you start your retired life. And in that instance, not too much means try not to draw more than 5% a year from the value of your living annuity. If you do that, it's sustainable. You're probably going to expect to get around about 10 or 11% a year for the next 3 decades or for the next 30 years. And if you're drawing 5, that means that you're leaving behind 6 to be reinvested, and that 6 hopefully equates to the inflation rate over the next 3 decades. So that's why 5% is important, that you don't go over that early on in retirement. And I think for most people, that's the big mistake they're going to make with a living annuity, is that they start and their living annuity, and they start drawing 8 or 9% a year, and it's impossible for any investment to grow fast enough to match inflation plus the amount that you're drawing out. So if Caroline, you're in a position where you can less, in other words, you could draw 4%, and it's not compromising your lifestyle too much, that's even better. But 4 to 5% for me is the ideal rate for people to draw from their capital when they stop work early on in retirement, at 65. The life annuity, it is an option if you're in a position where you don't have enough money already at retirement. So if drawing 5% is too little for you already, then a life annuity is basically a contract where you give all of your retirement money to a life assurance company. In exchange, they guarantee you an income for the remainder of your life. The thing they're not going to guarantee, which is tricky, is that they're not going to guarantee that your income rises at the same pace as inflation. So that's the problem with life annuities, is the guaranteed income is good, and the initial income will be a bit higher than what you can get from your living annuity, but you might be in a position where later on in life your cost of living has gone up more than the value of your income, and that's just the thing to balance out. So if you're in a position where you can draw 5% and that's sustainable for you, then I like the idea of a living annuity very much. But if you're going to be financially compromised on day one, then a life annuity will pay out literally for your entire life. And I think, that's important, where people with living annuities end up drawing, the maximum, which is 17.5%. And at some point that runs out, and they have no more pension or no more income and are still alive. And that's a catastrophic position to be in. So it is a tricky one to get right, Caroline. But I think in a situation like this, your amount that you need to draw is kind of the deciding factor between a living annuity and a life annuity. Whatever you do, please get lots of quotes. Please at least talk to 3 advisors to find out what each of them would recommend, and tell them what you're doing. Tell them that you're going to compare the advice from all 3, because by the end of that, you'll have a very good idea of what route will work for you, and you'll make an informed decision then. And don't be scared to ask whatever questions you want, and don't be scared to negotiate fees.
Warren Ingram, thank you. Warren is a certified financial planner. He is a co-founder at Galileo Capital and has got a good head on his shoulders. That's a good combination, really. Caroline, I hope that Warren's guidance to you this evening assists as we look at the value of the currency over the last 5 trading days. The rand has gained 6% in 5 trading days. Now, it doesn't mean that it's going to do that in the next 5 trading days, and it doesn't mean it won't retrace almost immediately. It is, unfortunately, what do they call it? The rattler. The rand is a massively volatile and unpredictable beast. But for the last 5 trading days, 6% gain. And those percentage points, when you do make investments, do matter. But markets are also forward pricing machines.